Welcome back to the channel. My name is Steven. I'm a pharmacist and I own 54 units of real estate. So happy Thanksgiving, everybody. Just wanted to mix it up a little bit, do a Thanksgiving special. So today I want to mix it up and talk about why I see a lot of real estate investors are starting to pivot. So if you've been watching real estate content from, I guess, 2012 all the way to 2022, the theme of the investors is leverage, debt is good, scale, right? That's kind of the themes that I kind of saw um, when I started watching content back in 2019. So I started really consuming content in 2019 until present day. And the theme of most real estate channels like Bigger Pockets, a lot of YouTube was, 10x, debt is good. There's good debt, there's bad debt. You want to scale. And, basically, if you're borrowing money at, let's say, 3%, but inflation is at 5%, then you can basically, your debt is eroding over time. So, debt was kind of put on a pedestal. It was held high. And that's how a lot of real estate investors scaled. Um, and obviously from 2012 to 2022, it was a good time. It was a bull market. But from 22 to, I would say, probably to 2025, it's been kind of stagnant. I feel like in 2025, I felt a little bit more pain in my portfolio personally, with more evictions, more turnaround, higher expenses, more capex. So everything just kind of hits you at the same time. So welcome to being a real estate investor. But I've been kind of noticing content now over the past few months have kind of pivoted. So people who are more about, get more units, leverage, scale, good debt, they're now pivoting towards, maybe I have enough. Maybe I got to start paying off debt. So it's kind of funny seeing this like change in the mindset of a lot of real estate investors and myself included, right? And I think it's because a lot of people that create content, myself is in this bucket too. We started investing when it was a good time, right? So if you started investing in 2000, I think 2012, which is after the great financial crisis, until 2022, you had a 10-year run where the real estate market did very well and interest rates are very low, right? I remember in 2017, my interest rate was 4%. And during COVID, it got to below 3%. So in 2012, I think the interest rate was about 4% as well. So I honestly think I said it before, but a healthy interest rate is around 5% is what I think. Um, but a lot of people were basically like investing in real estate during a good time. So if you're a fix and flipper, you could buy a deal. You could have bought it like wrong. You could have went over budget on renovations. Um, and from there, you can basically leverage that to scale further, right? Sorry, I lost my train of thought there. But basically, you can buy, you can leverage, and you can scale. And you can buy a property for a fix and flip. Oh, that was a topic. You can buy a fix and flip. You can buy it wrong. You can go over budget on your renovation, but because the value skyrocketed so much, you can still make money when you sell it. So I think a lot of real estate investors got away with that. Even like syndicators, a lot of syndicators, they could have overpaid for a property because interest rates were low, and they could have basically did some value add, do some renovations, increase the rents, lower some expenses, and then do a huge cash out refinance because cap rates are going down. And then that kind of covers yourself. So if you kind of overbought on the property, you over renovate the property, but the cap rates go down, the value goes up. And you can borrow at cheap debt at like 3%. But now that interest rates are like higher at like, let's say 7%, 8%, it really tests you as an operator. It makes sure that you have to buy right. You have to make sure that your underwriting is spot on and that you basically need to know your exit strategy very well. So it's really testing those operators, and myself included, right? I am being tested in terms of like operating my real estate portfolio. And it's kind of pushing me to the next level where I haven't been watching my expenses nearly as detailed as I am right now. Like now I'm watching everything so diligently because I'm not distracted by buying more real estate and scaling other things. But when you're in that scale mode, you're not focusing as much on your P&L. If I'm being honest, you're more focused on acquisition. You're more focused on stabilization. You're not looking at kind of the P&L statement. So from 2012 to 2022, you can get away with bad mistakes. But now in 2022 to probably 2025, your mistakes will get exposed now. So things you got away with is getting exposed. So maybe for me, maybe rents are always trending up, for example, but now rents have stayed stagnant, but expenses have gone up. So really, it's exposing how well are you operating your P&L? How well is your property manager managing the deal? Like, do you actually have a good property manager, or are they okay? Right? Like I think during this window for 2025, it's solidified that my 26 unit apartment complex property manager is very strong still. But my 20 unit, I think the expenses are a little bit too high. And I think they're just kind of just paying the bills for lack of a better word. So now I'm gonna meet more frequently with my 20 unit apartment complex property manager because I see that they're not managing the expenses very well compared to my 26 unit, and the properties are the same age. So that's what I mean. Like during the good times, everyone looks good, right? Like an okay property manager can look amazing during the good times because if rents keep on going up, but expenses go up, like it's kind of hidden. But now if rents are stagnant or going down, or and occupancy is going down and vacancy is going up, it's exposing these bad property managers. So like it's kind of interesting to see how I react to bad times as well as my property managers react to bad times, and how they pivot. So that's why I'm increasing, like, talking to my property managers. It used to be once a month, and from there, now I'm gonna do every 2 weeks or maybe 3 times a month or maybe once a week, right? Just to see how the expenses are going because my 20 unit's been hit with a lot of, like, plumbing issues, HVAC issues. I joke that my plumber and my HVAC guy makes more money than me. Like, I should just become an HVAC guy or plumber and fix my 20 unit. I'll make more money than my actual 20 unit, does itself. So I think in this time period, a lot of the, I guess, pretenders are getting exposed, and a lot of people who have larger portfolios are getting slapped in the face. So that's why I see a lot of the content pivoting from scale, 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 good debt. It's pivoting towards more of a Dave Ramsey approach, which is start paying off debt, slow down scaling, reassess your portfolio, and then basically sell the bad ones or the ones that you don't like or are underperforming, and use that to pay off the ones that you do want to keep. So that's the tone that I've been seeing a lot. Like I've been, I don't watch Bigger Pockets as much, but in their titles, more in the beginning, I remember like in 2019, they kept on bringing on a bunch of syndicators, a bunch of crazy success stories where people said, "Oh, I've got to 1,000 units in 1 year or 100 units in 1 year and quit my W-2." Like those were like the headlines in like during COVID. So if you listen to that content, it kind of almost brainwashed you to think you need to get a lot of units. And I was one of those that were brainwashed. That I thought more units meant more cash flow, meant more success, right? But then this only applies, I would say, if it's a good time, 2012 to 2022. But now that times are getting worse, it may get even more worse. Um, the tone is now changing towards small, mighty portfolio, having the least number of doors to hit your cash flow goal, have the least number of doors to hit financial freedom, so you have the least amount of headache, and to go slow and steady and to take debt off the table. Like now, that's kind of the theme, because I kind of was listening to I think a short from Henry Washington. So he's, I think, one of the co-hosts of Bigger Pockets, but I think he has like, I don't know, 150 units. He invests in cheaper markets like the Midwest, but he scaled to a decent amount. I think he did partner with people, so it may not all be his. But I saw a recent short where he was just like, "Oh, like I hit my enough. I basically want to start paying off properties and selling some properties to pay off other properties. And whatever money I make from my flips, I want to use that to pay off my other properties as well." So basically, he's moving towards more towards chill mode. So basically, trimming the portfolio, taking debt at the table, and owning something free and clear. Because you can't always fix and flip forever. For example, you can't always have active income forever. And the point of real estate is to be passive. So it's kind of interesting seeing like when times are good, it's just like scale, leverage, scale. Like I remember the Burr strategy was very, very popular when I first started getting invested in real estate, where you buy it, you fix it up, you rent it out, you refinance it, you pull out all your money, you have $0 in the deal, hopefully it still cash flows, and then you use the same money to go buy more deals. Like David Green, Brandon Turner, Bigger Pockets were very big on that topic. But the downside of the Burr is that you're leveraging, right? Like you're constantly just getting debt and recycling the same capital, but you're getting more debt, more debt, more debt, more debt. And, it's and once you kind of scale to a larger portfolio, what people don't realize is that, um, a lot of people are changing their tone now, myself included, is because, you get slapped in the face, right? Like, if you have like me, I have 54 units. If you have 10 HVAC units go out, or you have 10 toilets that need plumbing issues, that's like $3,000 to $5,000 in expenses, right? And then if you didn't account for that in your underwriting or in your reserves, it feels like it's coming out of your pocket. And with real estate, it takes at least 10 years to like own a stabilized portfolio. Um, so, for me, I'm on year 8 of 10. And, a lot of the people who invest in real estate have been doing it for less than 10 years, myself included. So like now it's kind of funny because now we're seeing, oh shoot, Dave Ramsey was right. Like don't leverage as much. And basically you want to go slow and steady. And a lot of people are pivoting, like selling to take something off the table. So, the only silver lining I would say of owning a lot of real estate is that it gives you the optionality to basically sell some to pay some off. And, I'm probably going to be doing that myself. But it's interesting seeing that people are pivoting towards that strategy because, when the times were great with low interest rates, it was a seller's market. Homes are appreciating like crazy. Net worth, people's net worth was going up by crazy. You can like get away with buying bad deals and still make it work. You can get away with, bad fix and flips that end up making you money. But now, like I said, you're put to the test. And you have to really operate well and then really know your numbers well. And if you're off, you can lose money on a deal. So now people, scaled up a lot, built up a decent net worth, and now they realize that, oh, this could be in jeopardy, right? If we continue to scale at this pace during this time and given all these expenses. So a lot of people are now kind of moving into a different direction. Um, now that basically we got slapped in the face with a harder time. And, this might not even be the worst yet. It could get, I always say there's three possibilities in life. It can get better or worse or stay the same. Um, so hopefully it gets better, but it could stay the same or it could get worse. So it's interesting seeing like all these like content creators now, especially specifically in real estate, they're like pivoting towards more like, oh, take, don't scale as much, slow and steady, pay off properties, and basically let your real estate portfolio like marinate. So that's kind of been the theme that I've been seeing now. And it's like a hard pivot before, which was like just scale, 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 leverage, leverage, leverage. And, and I get it conceptually. Like if you like had enough money from another source of income where you didn't need to live off your real estate, or you didn't mind if your real estate was like negative for like a year or two. So let's just say you made a bunch of money elsewhere. Yeah, you could afford to like cover your real estate portfolio if it's cash flow negative. But if you're trying to be financially free from real estate, if you're trying not to be as active in your business, like you have to structure your portfolio in a way where it's basically more passive, it's more guaranteed cash flow. And how to do that is with, I guess, less debt, to be honest, because basically rental income is not guaranteed. A mortgage is always guaranteed, right? So if a tenant stops paying me rent, I still have to pay the mortgage, and that's guaranteed. So if you have no mortgage, so then that means that you have no expense, and if you don't get rent, well, you still have no mortgage. So that's why now people are seeing that what Dave Ramsey is saying is correct, but it is hard to do what Dave Ramsey does because he makes a bunch of money from his business, and from that business, he buys houses cash. Like the average person who works a W-2, like myself, we cannot do that. Like if I had to save up 250K to buy a house cash, like it would take me like 5 years to do that. And then by then, the house might have gone up in value if it was during a bull run. So like if that's your unfair advantage, I would totally do that. Like if you can make so much money from your business that you can buy something all cash, do that. Right? It'll make your life so much easier. But if you, at least in the beginning, you probably have to leverage, right? You're putting 10% down, you're putting, 20% down, you're doing seller financing, maybe you're doing private money, maybe you're taking a HELOC, you're doing whatever you need to do to scale. But then once you kind of hit your enough, and that's the point where I kind of hit, that's when you have to start scaling back and re-optimizing your portfolio. Because like I said, at this point, me buying more or a lot of real estate investors buying more, it's actually going to hurt you versus help you. And it's going to hurt your goal. So for me, my goal was financial freedom, stepping away from my pharmacist W-2. And if I continue to scale, I know it's going to hurt that opportunity. I could lose everything potentially or lose a lot versus right now, take some chips off the table and play off house money. It's just like if you made $100 in blackjack or you put in $100 in blackjack, you made 100, just take away your original 100, and whatever you're playing with is just house money. So if you lose it, whatever you break even. So it's kind of interesting, but also kind of refreshing to see a lot of people pivoting towards a strategy. Like I said, a lot of these, YouTubers, content creators, we started investing. Um, Probably a lot of them is 2015. I started in 2017. So, obviously it's been a pretty nice bull run since, 2017, especially during COVID. So, but now people are getting slapped in the face where, times get tough. And then like if I were to lose my job on top of all this, like that'd be pretty tough, right? I would feel pressure to have to um, get another pharmacy job immediately. Maybe have to rent out a room in my house. So, for me, I want to structure it in a way where if I did lose my W-2, I want the real estate income to be like very secure and then low expenses. So, as I've kind of built more wealth, it's the key to success is not how much money you make, it's how little your expenses are. So if you can keep your housing expense low, if you can keep your real estate debt lower, it's that's when you get like true wealth and true financial freedom, right? So like I was kind of if I kept on going in the path I was going on, from 2017 to 2021, I just would have built myself another job that I probably would have not enjoyed, right? Which was like this real estate portfolio and dealing with, property managers, and most property managers are terrible, right? If I'm being honest. And then you're dealing with contractors, and most contractors are terrible. And, you're dealing with realtors. Most realtors are not that smart or that good. So like, I don't, I already deal with enough incompetence at work. I don't want to deal with more incompetence outside of work. So to me, like I think my sweet spot portfolio, it's probably gonna be around like mid 30s units, most of it being my 26 unit apartment complex. But like I said, as I build more wealth, I might become like Graham Stephan, where he makes so much from YouTube that owning real estate is not even worth it for him. So he'd rather just dump it into like the S&P 500, where it's easier, it's more passive. You don't think about it, less headache, and you don't have to deal with tenants, toilets, termites. So, for me, I think I was thinking why I chose real estate. I chose real estate because I thought that was the best way for me to build wealth. If I was good at business, I probably just would have done business, but I didn't think I was good at business, which is why I chose real estate because I think most millionaires are made through real estate. And what's nice about real estate, at least initially, is you can leverage your way in. But then once you kind of, built up a portfolio, once you've, kind of hit your enough number. So, like my portfolio grosses about 45K. Um, and like to me, if I had, let's just call it 20K net, positive income, like that's good enough. So I can get there, but I probably have to sell some to pay some off, and then sell some to pay off my primary. And then eventually I can get there. And if I were to own a portfolio free and clear, like you can always scale up again if you want to, right? But you can scale up at a much slower pace and then just see how your portfolio performs over time. So, like before, I felt like I had a gun in my head and I had to buy 100 units. Now it's just kind of like, oh, if I want to buy something, it has to really make sense in my overall big picture, in my overall portfolio, and in my overall kind of like life situation. So it's a lot more I guess less numbers based, which is what I was in the beginning, and it's more like lifestyle based now. So I guess that's the privilege that I've earned after grinding for 8 years. But yeah, it became very interesting just to see a lot of the other content creators pivot towards that like strategy of basically not scaling as much and then buying less. Like if you see now, like syndicators, you don't see as much syndication. I mean, during COVID, I remember in 2017 when I first got started, Airbnb was so hot. Short-term rentals was so hot. A lot of people, I mean, one of the bigger pockets host, Rob, does a bunch of Airbnb short-term rentals. And then now, fast forward 5 years later or 8 years later, you don't hear much people talking about Airbnb short-term rentals. It was just a nice fad. I mean, it's a great way to make money fast. You can do the short-term rental loophole to offset your W-2 active income, but it's not a scalable business. So that's why a lot of these Airbnb operators, they make most of their money, with mentorship and coaching. And then they ended up selling their Airbnbs and 1031 exchange it into a hotel. So a more scaled up version of an Airbnb is essentially a hotel. So they basically, I think Rob 1031 most of his Airbnbs into a hotel. And that's the more scaled up version of Airbnb operator. Because I don't know any Airbnb operator that owns like 40 Airbnbs, right? It's not super scalable. So, and in terms of like single family homes, so the more scaled version of single family home is multifamily, But once you go into multifamily, like there's pros and cons, right? Like the insurance is more expensive. You have more tenant turnover. You have more tenant expenses. You have more toilets that can break. You have more flooding issues. If you have a flooding issue in an apartment complex, you can affect not only the unit, but the unit below it or the unit to the left of it. Versus a single family home, typically it's just isolated to that unit. Um, Property taxes are typically gonna be a little higher on multifamily, and then you have to deal with balloon payments, right? So in commercial real estate apartments, 5+ units, you have a balloon payment every 10 years, every 3 years, every 5 years, depending on which balloon payment you do. So you have to think about it. Versus single family, it's 30 years fixed, right? So like someone asked me like, what's the perfect portfolio? If you can own 20 properties, let's say free and clear, new construction, and maybe each gets like 2,000 bucks a month in rent. I mean, that's 40K gross. And maybe if you own it free and clear, maybe it's 30K net. If you factor in all the property tax, insurance, property management, reserves, that's like 30, let's say 25 to 30K in net positive income. And that's enough to like live a very good life. Right. So like I have to like remind myself, take the ego out of the way, just focus on the real estate where it makes sense, and then scale slow and steady. And like now, like honestly at my point, because I've been doing it for a while, like real estate isn't as exciting as it was before. Like in the beginning it felt like a dopamine rush, it felt like an adrenaline rush, but at this point it's just kind of like, I've owned it for a while. It's kind of boring in a way, but it's supposed to be boring, and that's when you start to build a massive amount of wealth. So just kind of want to share how like I found it interesting. A lot of you know real estate investors are pivoting their strategy. They're more pivoting towards principal pay down, debt pay down. And like for what I tell people too is like, people say like, okay, well, if you have a 3% interest rate on your primary residence, why would you pay that off? Right? You could instead of putting extra $1,000 to pay down your 3% interest rate, you can dump that into SP 500, which averages 7 to 10%. So you look at it from a numbers perspective, that's correct. But I think what one thing people miss is that not everything is always about numbers, right? It's something about like peace of mind. If you want to be financially free, if you want to take care of your family, you can't, it's hard to put a price on that. And then another thing too is like, if you look at a monthly payment on a loan, a mortgage that's amortized over 30 years, if you look at like the first year, like let's say your payment's 2,000 bucks, out of that 2,000, maybe like 400 goes to principal pay down and 1,600 goes to interest. So with homes, it's front loaded in terms of how much interest you pay. So the banks get their money back fast. And about midpoint, when you're at year 15 at 30, that's when it might be a little bit more principal, less interest. So like something that I've like considered doing is if I can't pay off my home immediately, if you just do a lump sum on your primary, you can accelerate your amortization schedule from maybe year one, maybe closer to year 15. At which point, when you make a monthly payment, more is going to principal and less is going to interest. So that's something that I've thought about too. And another thing that I kind of realized too is like a lot of real estate investors, they'll just throw out like, "Oh, I'm investing in real estate for legacy," right? And I never really bought into legacy because like a lot of times, like, I don't even have my kids yet, and even if I do have kids, they might have zero interest in real estate. Like this is definitely a real thing. Like I know a lot of real estate investors where their kids have zero interest in real estate. So what's going to happen is, imagine if me, let's say I scale to 100 units, want to pass it off to my kids. My kids may hate real estate, may want nothing to do with real estate, at which point I'm going to have to sell it all. Right. So like, if you kind of know that, like I don't even know my kids like it. Hopefully one does like it, but if both don't like it, that's fine. And I think for me, the legacy is not about like what you're passing to your kids. I think it's more about like the knowledge that you pass on. So that's what kind of stemmed me in creating YouTube videos so that my future kids can watch my videos and see what my mindset was when I was like 31, 32, 33, 34, 35. And that's the true legacy. It's the knowledge, it's the skill set. And, yes, I am probably going to pass stuff off to my kids, right? Like, have a life insurance policy, and then they'll probably get like a few paid off rentals at least. But kind of knowing that's enough. So if I do that, that's already good enough. Like that's more than probably what I'm going to get when I inherit from my parents, or my wife and I inherit from our parents. So like for me, I never really bought into the whole legacy thing. And then if you kind of look at, I think I forgot where I saw it, but like it takes 3 generations to blow wealth, right? So like let's say I built wealth And then my kids, let's say they don't really care about real estate, they don't really care about wealth, they just spend money, and then they have my grandkids, they basically are the same. And then by the next generation after that, like all your wealth is gone. So there's no real legacy. The only real legacy is like stuff that we pass on through storytelling, through the lessons that we learn, and kind of through mindset and through education. That's the true legacy. Like physical assets, like that goes away after 3 generations. I see it. Like I live in LA, and I see a bunch of people who grew up in rich families, and they're the kids of the rich families, like they're not successful, and then they're basically their view of spending money is so skewed that I know that it's gonna blow eventually. Like they're gonna blow all their money eventually because they're just their view of spending money is so like fabricated. Like I know somebody where I think the net worth must be 100 million plus, and they just dumped $5 million into like this company for their son, and literally the company doesn't even have to be successful. They're just buying a story for their son so that they can show off to their friends and family that they own that the son owns a company, but it's fully funded by like the parents. So like it's not tricking anybody, right? Like if the only thing that would trick are like people who are poorer than you, but people who are like your level or like who are self-made, they see right through it, right? So like it's kind of interesting kind of seeing that. Like I'm not impressed by someone like spending a lot of money and like flexing. I'm more impressed by people who like put in the work. Like the people who like work a full-time job and on the side they're trying to grind and build a business or grind and build a real estate portfolio. That's like the true what's truly like impressive to me is it's just seeing that like grind and the work ethic. So it's quite interesting. They say if you want to impress a poor person, spend more than them. If you want to impress a wealthy person, outwork them, right? So like I've kind of taken that to heart as well. And then like back to the legacy point, like I said, like I'm not too fixated on it. And basically, it's not as important to me. Like for me, like I'm fine. My legacy goes away. Like I just want knowledge to be passed down, hopefully through the generations and the mindset. Um, that I kind of built. So I guess before I start answering questions, basically I want to talk about since it's Thanksgiving, what I'm grateful for. So I am terrible at pausing and reflecting and thinking about what I'm grateful for. But 2025 has been a pretty eventful year for me, I would say. I got married, so very thankful to get married to Christine, and thankful for basically being able to travel like whenever I want without worrying about the money. Essentially, like I don't travel super lavishly, but I went to Cabo this year. I went to Glacier National Park. I went to Costa Rica, and I just went to Vietnam. So like I can travel whenever I want, do what I want, and not really worry about it, right? And very grateful for scaling my real estate portfolio. It's giving me a lot of headache recently in 2025, but like still very fortunate to like be able to like be in America and be able to scale to 54 units without any partners, without coming from a rich family, without with a high income W-2, I would say, but like nothing super crazy. Like I don't make millions, and just having the opportunity to do that. Like I know like in Asia, like in order even just to rent, you literally have to like you have to have like I think 6 to 12 months of reserves to show your landlord if you want to rent in Asia. So like if the rent is $1,000, you have to have at least 12K in your bank account, 6 to 12K in your bank account just to be able to rent the property. But here, in America, you just can put like $50 down sometimes as a deposit. You can move right in. So, America is more focused on credit. That's why the stereotype is Asians have a lot of cash, is because I think you had to in Asia if you want to rent a place. Albeit it is a little cheaper probably to rent in Asia than compared to America. But yeah, just very fortunate that I was kind of born here, and then I have the opportunity to grind, buy real estate without much of an advantage. Besides, I just grew up middle class, but my parents didn't really know real estate. But to be able to learn real estate, to be able to buy real estate with like 10% down, with 30-year fixed debt, a lot of countries don't have that. So the fact that I have that as an option makes me feel very fortunate. And I'm very thankful that like just because my real estate portfolio is larger, I can make pivots accordingly to fulfill my lifestyle, to fulfill my goal, right? Like I said, I could literally sell my entire portfolio. Said it yesterday in my life. Sell all my portfolio, pay taxes, a lot of taxes, pay off my primary, dump the rest in SP 500, live off that 4% rule, and that's enough for me to live a good life, to be honest, like right now. So very thankful for that optionality. Thankful for, not if I say this, but having a W-2 job that's like reasonable, and basically thankful for like kind of the community that we lived in, or moved into. Like it's a new construction community. Like there's a pool here, there's a gym here, so it makes it easy for me to like still maintain like my health, um, and my sanity, despite this grind, because everything's so easy. I can walk to the gym, I can walk to the pool, I could walk around the community. It feels safe here. It's a gated community. So, very fortunate to be able to find this property and be able to live here and to afford it and be able to pay it off too. Like, a lot of like looking back, like a lot of people my age are still trying to buy houses, like their house to live in. And I'm fortunate that I can be able to pay it off if I want to. Very thankful for YouTube, be able to document my journey for free and to learn for free on YouTube University, from people's experiences. Very fortunate for that. And then, like I said, very fortunate to basically have a pretty core group of friends that I've had since like high school. We still keep in touch. We still have kind of a similar mindset of wanting to grow and do better. Because I know a lot of people that you have to get rid of your high school friends sometimes. You want to grow and develop. Fortunately for me, I maintained a lot of my high school friends, because they still kind of have that same mindset of not overspending, not being over lavish, not being arrogant, not being cocky, but just wanting to improve slowly and then build wealth slowly over time. So very fortunate for that. And then I would say the thing I'm most thankful for is just all the realizations that I've gained in 2025. Like it's been a very like huge identity shift for me in 2025 to go from like a real estate like scaler, like scaling my real estate, to just more being okay with optimizing it. Like at this point, like I don't even want to buy any more real estate. I probably it's better off for me to start selling and then paying off some properties and then repivoting my portfolio accordingly. Unless like someone throws me an amazing deal, I just can't imagine doing that. And then like I think um getting clarity on the sense of like I need to focus on like building up more active income. So obviously my pharmacist income, it's capped. Every year at best I get a 3% raise if I'm lucky. So focusing on like becoming a real estate broker who focuses on just selling Lennar homes. So instead of like getting 100 units, my new goal is I want to sell 100 Lennar homes in Alabama, Oklahoma, and California. So hoping to get my broker's license in about 3 months. So hopefully by like end of quarter one of 2026, before my 36th birthday, I can become a real estate broker and just start selling these homes and make it my goal to help sell new builds, Lennar homes or new build homes to investors who want to like get a little bit more cash flow and want something more turnkey. So that's kind of pivot to my goal right there. But it's like no pressure on me because like I don't need that money to survive. But if I can do it, great. It allows me to step away from W2 faster. But I'm sure being a real estate broker has its own headache too. That I'll find out because dealing with people always has a headache. And then lastly, I'm pretty thankful that I've been focusing more on health in 2025. So I kind of let it go a little bit during COVID when I was scaling my real estate portfolio. Like I wasn't as focused on going to the gym, wasn't focused on my diet as much, like wasn't as compliant seeing the doctor. Ironically, I work in a hospital and I'm like bad at seeing the doctor. Most healthcare workers, if I'm being honest, they're terrible with seeing their doctor despite working in a hospital or despite working in a clinic because maybe we think we know better. But anyways, yeah, just been refocusing my health, and then going to the gym more consistently, and basically, optimizing my sleep, optimizing my diet, optimizing my supplement regimen, and basically really controlling my mind. I think my mind tends to run a little overactive and thinks too much. So like finding ways to like think less, to calm my mind down and to optimize my health has been like a nice pivot for me in 2025 to regain that back. And then realizing that I can't lift how I used to lift when I was 25. When I was 25, I used to like power lift, like deadlift, bench, squat. But now that I'm 35, sometimes your joints hurt, right? And so I know like deadlifting and squatting heavy weights it's more injury prone and it's not a sustainable way to work out. So like kind of getting over that whole thing of like I need to lift heavy. Um, has been nice, for me as well. And then, like I said, like not needing to scale and like I kind of hit my enough. Like, to be honest, like at this point, if I kind of cruise and do nothing, even despite selling, I could probably hit a $10 million net worth. Just cruising over the next like maybe 10 to 20 years, depending on how the market does and how real estate does. And at that point, it's just like, I know like my wife and I, we don't spend that much, which I'm very fortunate for. Like we're not very materialistic at this point. Like Christmas is coming. Like it's so hard for like me to buy for my wife and for me to like, for my wife to buy for me. Cause like, we don't really like need that much stuff to be at this point, too much stuff is like kind of causing more stress than good. And then like we rather like focus on spending on experiences like travel. Obviously, we're limited to PTO right now, or whenever work gives me time off. Um, so it's just like we live pretty like humbly and like I don't know. Like I went to like grocery shop one day and I was buying like eggs and chicken one day, and I was just like, man, I didn't realize like how cheap it was. Like I bought 60 eggs for like $7. I was like, how can you buy 60 eggs for $7? That's crazy to me. And then on top of that, I bought like a bag of 10 pound of chicken, like I think quarter chickens. That's the thigh and drumstick. It was like $10. I was like, wait, for $20, I got 60 eggs and like literally 10 pounds of chicken. Like that's crazy to me. Like, so anyways, like you need as much money as you need to live. Albeit I might change my mind once I have kids, right? So that's what I'm thankful for. So please drop what you're thankful for in the comments. So let me start checking out these comments now. Um, let's see here. Sam, good day, sir. Glad to see it pays off to be an investor. Um, if you ask a lot of investors right now, they think it's stressful to be an investor, but yes, it's just a bad period in time. And as everything good and bad, it will pass eventually, as long as you survive. And then you can continue buying real estate or continue to own your real estate. I see Kevin. Good afternoon from Lakeland, Florida. Thanks for hopping on. It's East Coast time. Sam, I see. Yes, what supersedes a property manager or the underwriter if two things cannot be put in the same sentence? So, like a lot of times, property managers, especially the okay ones, they're just focused on solving the problem. So if there's a plumbing issue in unit number 2, they just want to solve the plumbing problem in unit number 2. They don't care how much it costs. So you have to be on top of them for the cost. And that's what I'm trying to do now too. Like I see all the bills now. I haven't been as diligent watching it, but now I look at each bill and be like, well, like, is this my bill or is it the tenant's bill? Right? Because if it's a tenant's fault, I shouldn't have to pay. It should be passed on to the tenant, not onto me. So it's just more of like hashing through it and seeing which ones could be passed on the tenant, which one's yours. Like if it's at my expense, I don't care. I'll pay for it. But like I just want to make sure they're diligent. And also I look at the quotes. I'm like, is it really going to cost $300 to change a flapper on a toilet? Probably not. Right. So if that's the quote I'm getting, that doesn't make sense. So, you kind of have to know your prices and look at each bill more diligently, which I've been slacking on. And I want to do more diligently, starting in December and 2026. Right. And then underwriters. So interesting thing. So I am doing a cash out refinance on my property I bought in Huntsville. Right. You guys, if you've been following my channel, I bought a property in Huntsville. So originally listed for 307K. They dropped the price to 295K because it was end of quarter for Lennar. And because I offered all cash, they dropped the price to, I think it was 256K, something like that. So what I wanted to do was buy it all cash, get it rented out, and do a refinance at the ARV. So a lot of times lenders want 3 months of seasoning to honor the ARV. So let's just say I bought for 256, but the original price was 307K. But I looked at sales comps, I thought it'd be worth 330K, right? So if you do a 75% cash out refinance based on 330K, what's that number? It's about 260. So that's a perfect burr of doing zero renovation, no hammers. I call it the lazy burr. You buy it, you rent it, you refinance, you repeat. And I was trying to do that for many properties. And hopefully the property kind of breaks even on the deal, factoring, CapEx, maintenance, repairs, vacancies. I mean, if it's new construction, the CapEx should be less, hopefully, and the maintenance should be less, but you still might have vacancy. So, like, I got an appraisal on the property, and the appraisal came back at 307K. So I was bummed. I was like, oh my God, I can only do 75% of 307K, which ends up being about like, I think 230. So I ended up thought I was gonna leave 30K in the deal. But I literally just got my numbers back yesterday and I saw the numbers. I was like, wait, the ARV says 330K. which is what I thought the ARV was. So the amount of money I could pull out is around 248K. So I'm all in for about, let's say 260. So I'm leaving 12K in the deal. I thought I was gonna leave 30K in the deal. So I just said, wait, like the lender completely disregarded the appraisal because the appraisal was 307K. Like you're supposed to just honor the appraisal and do a cash out based on the appraisal, but they still gave me the 330. And I think it's because they I think it's because they saw that the debt service coverage ratio is good. So the debt service coverage ratio is 1.28. So what does that mean? What does a debt service coverage ratio 1.28 means? It means that the rental income is 28% higher than all the expenses. What are the expenses the underwriter is looking at? It's looking at um, what's the principal, what's the interest, what's the property tax, what's the insurance, and what's the HOA, if any. That's all they look at, right? But when I looked at the numbers, I underwrote it wrong. They underwrote it wrong too. Like the principal and interest, they know, right? It's based on the interest rate. It's based on your loan. That's easy. So my interest rate ends up being 6.625 with a 5-year prepay, and I think the loan amount is 248K. So they calculated that. The taxes they got wrong, and I got wrong too, because the property tax rate for Huntsville is 0.32% if you own the home yourself as a primary residence. But if you're an investor, they double it. I didn't know that, right? I just learned it the hard way. So it's really 0.64%, which is double what I thought, right? So, and then, insurance, I just gave him a quote for my insurance. So that's accurate. And HOA is pretty accurate. So so if they factor in the doubled property tax, the debt service coverage ratio is not 1.28. It's probably like maybe 1.15. I don't know. I'm just making it up. It's probably a little lower, which is still good enough for them. It's 15% higher. But what does this not factor into the equation? It doesn't factor CapEx. It doesn't factor maintenance. It doesn't factor vacancy, right? And those are real expenses, right? That might end up being another, let's say 15%. So at that point, it's kind of a break-even deal, right? If you factor all that in. So underwriters don't care. They just want to do whatever to get the deal funded because they make money when they do loans, right? So don't think that underwriters and lenders have your back. They will do whatever they need to do to tell a story to get the loan approved so that everyone gets paid, right? So don't think that like the lender is your big brother. It's not. Like you still have to do your own due diligence, right? Like they have their own agenda of underwriters. Andrew, thanks for hopping on again. Happy Thanksgiving. Let's be thankful for our real estate portfolios. I need that, right? I'm not having the greatest time with my real estate portfolio right now, but definitely need that. Andrew, what are your thoughts on the stock market potentially being overvalued and crashing in the near future? A lot of speculation here. So for me, I don't really pay attention to the stocks. I'll be honest. I probably have, let's see, my 401k, my life insurance, brokerage accounts, IRAs, all that good stuff, probably over $1 million invested in there. I don't really pay attention to it. I just have index funds through Vanguard, some Apple stocks and some Nvidia stocks. I don't even watch the news. I just dollar cost average. And then I think over time, it's just going to go up organically. But yes, there might be a period where the stock market does crash, it's overvalued. But at which case, I think I just would keep my money in there and just let it continue to dollar cost average, right? So I think that's the best investor for stocks is the one that loses the login information to their account, because that means they never check it and they won't sell it. They won't fear sell, right? I heard a lot of people in 2008 when it crashed, like let's say you had $1 million in stocks, it crashed 50% to 500,000. They sold, they put their money in the sideline, and they missed the bull run from 2010 all the way to maybe present day. So I don't really know much about the stocks, but I just dollar cost average. It's super simple. It's made me decently wealthy just dollar cost averaging, and I don't really pay attention to it. So, my energy is spent more towards, I guess, real estate for better, for worse. So don't really know too much about the stock market. Wish I did. But I just do the S&P 500, Vanguard index funds, dollar cost average. I like to keep it simple. KISS, keep it simple, stupid. I didn't learn that lesson with real estate, though. Another question: have you considered a long-term goal of paying off your single-family homes that you rent and having those as your core real estate portfolio with the ADUs? So yes, I have. So I think my core right now is probably going to be so my 20 units not part of my core. I'm probably going to sell that. It might take me a year, but I want to sell it. My 26 unit right now, I can see it being in my core, but maybe in 5 to 10 years, if I have a bunch of capex issues, I may change my mind. Obviously, the house I'm living in right now, I consider it to be my forever home. I'm probably going to live here for the rest of my life. We like the location. it's between Orange County, it's between LA. So right now it makes sense unless we want to leave LA. But while we're in LA, this place makes the most sense to us. So I want to have this house owned free and clear. I own a house in Orange County, which I probably want to keep in my portfolio. It's a great location. I might move into that house one day. I don't know. But that's the house where I'm probably going to sell my 20 unit and then use that money to build an ADU. So I'm going to build a detached ADU in the backyard. And I'm going to convert the garage to a 1 bedroom, 1 bath. So I may move into that unit one day and then maybe live near my tenants. I'll see. But like that, um, the two ADUs, if you watch my channel, it's going to cost me about 400K, but I'm going to get about 6,000 bucks in rent. And a lot of that's going to be pure profit because there's no debt and my property tax won't go up that much more. And my insurance won't go up that much more despite adding those two ADUs. So I'm thinking like that would be like, I don't know, five to $6,000 net positive cash flow, which is, what is that? Like 60 to 70K a month in net, right? So I definitely see that property staying in my core. And the main house has a 2.8%, 2.8% interest rate. I locked it in during COVID. So not super motivated to pay that one off because it's such a low interest rate, but I still see that property being in my core. I own one in the Bay Area. Um, I see that being my core in Milpitas. That's where my hometown. That's where I grew up. I own one in Livermore, which I like being in my core. I own one in San Francisco, which I probably see myself selling. It's kind of like a duplex in San Francisco. I mean, it's a great property. It's a great location, but it's just like it's so old. Like the property is like over 100 years old. So, I think the best value up to a certain point is just to tear it down and then rebuild something from scratch. Maybe I'll do that if I can afford that. But as it is, like the infrastructure is just so old. Like anytime it rains, because the wood gets so soft and soaked, like there's always like a water leak somewhere. But that's just how it is when you own a property that's over 100 years old, right? Like I think it's very common when it rains, you get one leak and you just put a bucket there and call it a day. But like that property, I have to pay utilities because it's a makeshift duplex. So basically not my, it's kind of far away from like my family too. So like it's just hard to manage, but like we'll see. I'm hoping SF surges again. I just can sell it for a good price and then, maybe use that to pay off my other one. I do see my three in Huntsville being part of my core portfolio because it's, each of them were 250K and each rent for about 2,000. So imagine if I owned 10 of those free and clear. So I own 10 in Huntsville free and clear. That's about 20K a month gross. And then maybe net might be maybe 15K if you factor in like expenses and reserves and all that stuff, or even 10K. Like that's pretty good too. My 26 unit, like I said, I see it being in my core. I probably do want to pay it off. I mean, fortunately, I didn't burr that property. I didn't get more debt in that property. Like it's worth about 1.6 million right now, but my debt's only about 350K. So I could easily sell a property, pay that one off. Don't have to deal with balloon payments anymore. Don't have to deal with, variable interest rates and that. But like I said, I don't know if I want to keep this long term because C-class apartments get a lot of capex issues that can wipe out your cash flow. So I'll see. Like right now, it's doing very well because I renovated recently and I have a great property manager. But the situation may change. If it does change, then I might just 1031 that 26 unit and maybe buy something all cash, or buy multiple all cash in Huntsville. Like if I sold it for let's say 1.6 million for easy math. Let's say my loan is 400. I have $1.2 million, and I can use that to basically buy a bunch of 250K homes in Huntsville. So that's what, maybe 8, 9 homes free and clear. And then those would be generating, let's say 2,000 bucks each in rent. So that's about 16K gross and maybe 12 or 10 to 12K net after expenses and reserves. So like that could be the move too, right? Like I haven't written that off the table. Like right now, my 26 unit is my LeBron James, my Stephen Curry, my real estate portfolio. Go Warriors if you're a Warriors fan, and Niners, unfortunately. But basically, like that's the move I can do, or I just can sell my 26 unit and pay taxes and dump in SP 500 if I'm done with real estate, right? So like I'm not married to anything. I just want to pivot my portfolio in a way that makes sense for cash flow, in a way that makes sense for lifestyle, right? That's the whole reason why I went into real estate in the first place. So yeah, I definitely am reassessing over the next few years. I'm not going to buy anymore. I'm gonna reassess what I want to keep long term and what I want to offload. And I think a lot of other real estate investors are doing that as well. Get off the ones that, if you own enough real estate, you have the ones that don't do well that you want to sell, and you have the ones that you would keep long term, right? So definitely, probably want to pay off some single family homes. Um, and and yes, Andrew, to your point, my ADUs, I want to self manage the properties myself. So when I self manage, I have very low tenant turnover. To be honest, like I've had the same tenant in my first house since 2019, my other house since 2020, the other house since 2021. It's been the same tenants, and like it's like they know me, I know them. Half the times it's just me texting a handyman to fix something, like every couple months if needed. So it's not super a lot of work. And once you have your handyman in place, like you just let them know, right? Like so yeah, it's about minimizing headache. And that's the whole point of real estate, right? Like I don't want to pass off a headache to my kids. I don't mind dealing with a headache, but if something happens to me, I know my wife doesn't want to deal with the headache. My kids, who knows? Maybe they're as sadistic or as me. And um, if you guys believe like the Chinese zodiac or like the Asian zodiac, like I'm year of the horse. I was born in 1990, and like I'm a metal horse specifically. So like metal horse means that they're very resilient and they just keep on running straight forward despite getting damaged. But the downside of that is you burn out and you might inflict a lot of self damage on yourself. And that's me to a definition. Like I just run forward and I get damaged and I just keep on running, and then eventually I'll stop and pause. Right. Um, so kind of interesting tidbit about the Asian zodiac there. But yes, I'm year of the horse. And um, I guess I'm sadistic. But yes, I want to optimize towards like um yeah, easier portfolio, less headache, more cash flow, less debt, right? I'm not going to be a Robert Kiyosaki and have enough debt until I die, right? That's not my goal. Um Question here from Maddie. How do you have time to do your full-time pharmacy job, manage a portfolio, and grow the broker business? Good question. So I actually was gonna make a video about this or do another live stream about it because that's a great question. So basically, my pharmacy job is Monday through Friday, about 8 to, let's just call it, to 6 between the commute, right? So that's most of my day, if I'm being honest. And for me, I like to sleep 8 hours a day. So I'm usually in bed by 10 o'clock. So if I get home at 6, I have 6 to 10 to really do my work, right? So 6 to 10 is when if you see my live streams, always around like 7 or 8 because I've just finished dinner at the time. Um, um, So that's why you see me do later live streams because like that's the only time I have. If you see me filming my content, it's when I'm driving to work. If you see me sitting in my Tesla, self-driving myself, I'm filming content while driving to work because I commute 2 hours a day, stuck in traffic in LA. So I maximize my time, right? And it's tiring. I could sit there, and listen to music, or just sit there in silence. But I want to create. That's when I create my content. If you see it. On top of that, a lot of times my property managers, they communicate to me via email, via text. So, if I have time during work, if I have time during breaks, during lunch hours, maybe in the morning when I wake up, because most of my properties are in East Coast time or Central time, I just text them, respond. And for me, like what I learned is like you want to take quick action and respond as fast as possible. Like if the decision takes like, or like if you can make a decision within like 2 minutes, just make the decision, right? If you need more information, if you can't make the decision, you just need more information. If that's the case, I will call the property manager immediately, ask them for more information so I can make my decision, right? So I've always been very quick in making decisions. Like I don't like fester on decisions. I just understand, gather data, make a decision, and pivot if needed, right? That's how I am geared. So that's how I move so fast, right? You just make quick decisions. And so a lot of it, it's done, maybe during my lunch hour or during breaks, if I have a few minutes of downtime at work, just send a quick email, send a quick text message, do a quick phone call. You can handle a lot of your business that way. And basically, balancing that with, obviously spending time on my wife. So typically on the weekends and after work, that's the time I spend on my wife and friends and family, right? Like usually I go out after work. Usually I'll spend time out with my wife. We'll like go to the gym. We'll like go eat somewhere. We'll relax on the weekend. If she's off, we'll go off. Like my wife's working today in the hospital. So that's why I'm doing a live stream because my wife's not here. Maybe my wife's on the live stream. If you are, I love you. And it's really, balancing. And then on top of that, I'm trying to balance like a social life, trying to balance my YouTube business or my media business, and then also becoming a broker. So if you look at all of it, it's very like synergistic in my mind. Like social media, like people come to me for my referral of my property manager and my realtor to buy a Lennar home, but literally Lennar, all the realtor does is kick over you. If let's say you want to use my property manager realtor as your realtor and property manager, all she does is she kicks you over to Lennar agent. Lennar agent does everything. So like I could do that, right? Like I can literally do that and it requires no work at all. That's why I want to sell Lennar new construction homes because all I'm gonna do is, hey, I'll help you underwrite the deal. I'll connect you with my lender. I use Ameritrust and Lending One, right? I'll connect you with my insurance. I use Steadily. And then from there, I literally will just kick you over to Lennar and then they'll help you, close a deal or whatever. And Lennar has the lenders too. If you want to use their lenders, they'll buy down your interest rate to like 5%. And then once you close, I just kick you over to my property manager, and that's it. Like I could do that. That's pretty easy. That's why if I tell people my goal if I become a real estate broker, I only want to sell new construction, and I'll help friends and family here and there sell homes. But I don't want to deal. I don't want to be that realtor who drives people around showing them 10 houses for them not to buy. That's a waste of my time. I only want to sell new homes to investors, right? So if you want to buy a Lennar home in California, Alabama, Oklahoma, keep me in mind. I'll help you underwrite the deal. I'll connect you with my lenders and I'll help you with insurance. That's more than my property manager does in realtor, right? So like I'll do that, right? And like their commissions are like insane. Like they don't even do much work. Like I felt like I was doing more work helping this investor get the deal than Lennar did and also the realtor did. Like I helped them underwrite the deal, I helped get the financing, I helped with the insurance of Steadily. And then like I got nothing. And then the realtors got like $10,000 commission checks doing absolutely nothing. So I was like, this is a sign that I need to become a real estate broker. And my goal now is to sell 100 Lennar homes. That's my new goal. Screw scaling to 100 units. Been there, done that. I want to sell 100 Lennar homes, and I will document each one I sell for you guys to get there. Um, so like, it's all synergistic. Like thanks to social media, it funnels people into, basically school. It funnels people into coaching, mentorship if they want that route, courses. It funnels into my real estate brokerage business eventually. Like I said, I don't plan on having people underneath me. I don't plan on having an office. I literally just want to be an independent solo broker, helping people buy investment properties, specifically new construction only. That's it. Like I'm gonna be super niche and super focused, and that's it. And hopefully, I'll be the best Lennar seller for investors in Oklahoma, California, and Oklahoma. Well, it's probably hard to invest in California unless you're super rich. So maybe if you want to buy a Lennar home in California, like me. Like I still feel like I have a lot of downtime. Like I watch a bunch of sports. I watch 49ers. I watch Warriors. I watch all the Netflix shows. I watch all the K dramas. So like it's just really optimizing your time and basically like I don't really watch that much social media. Ironically, like I don't like do Instagram shorts or TikTok. I don't even go on that. I just like listen to like podcasts, long form, and usually when I'm listening to podcasts, I'm doing errands. Um, and like if I'm washing dishes or whatever, like I usually just have a podcast on. If I'm like doing laundry, I just have a podcast on. Sometimes like I'll have the Warriors game on silent, and I just will be listening to the podcast as I'm like watching the Warriors game. So it's really like building your business around your lifestyle, right? Like, so I think I do a lot, and I have the same 24 hours in a day, so it is doable. But you just have to make quick decisions, automate things as much as possible. So I auto pay everything. You want to create systems. I'm still working on building my systems. You want to stay organized. Like for me, like I have so many like bank logins and like account logins. And I'm trying to keep that more organized. And then you basically, like I said, want to really systemize things and take quick action, right? So that's how I'm going to balance being a full-time pharmacist, managing my 54 units, becoming a real estate broker, and doing my social media business on top of that, right? Like to me, social media, I actually started social media. If you see my earlier videos, back when I was small, very, very small, it was just therapy for me. Like I was like super stressed. I was at rock bottom and I just felt like I had no one to talk to. So that's why I created content so that other people can learn from that and maybe it would attract the tribe of people that would I can commiserate with or I can learn from, right? That's why I created the school community as well, because I just want to network of investors who, they're going through the same struggle. And like for me, as you guys know, I'm super transparent to a fault probably, but I share the good, the bad, the ugly. And a lot of these, investors or people on YouTube, they don't share the ugly, right? Like Brandon Turner, he only shares the good stuff. He alludes to the bad stuff, but if you invest in the syndication funds, a lot of those investors are not getting paid, right? So like, of course, he's not going to talk about that. Instead, he's posting posts about how to be financially free from real estate. But I don't tell me someone who's financially free from syndication, like investing in a syndication. Nobody. The only person who's financially free from syndication is a syndicator, the person making money off the fees, the person making money off acquisition fees, disposition fees, asset management fees. Like I don't know anyone who's became rich from investing as an LP. People made money somewhere else and they invested as an LP into real estate to diversify. That's it, right? But they didn't make their money from uh, syndication. So like that's why I never bought into that whole syndication model. Like, I get it's appealing. You can use other people's money, but you can also lose other people's money. And I think for me, it just doesn't sit right for me to like invest other people's money. So I'm glad that I never went down that route and didn't need to go down that route because I have a decent W-2 income and I basically live a very frugal lifestyle. So that's how I juggle all that. It's doable, right? So I'm documenting it because I want to be proof. Obviously, once I have kids later in the future, my time is gonna be even more limited. So I might have to be waking up early and doing early live streams, right? You wake up before your kids wake up and then do live streams. So that's why I've been grinding hard before I have more obligations, right? Once I have more obligations, I get it's gonna be harder to do things once you have kids and spend time with them and do activities with them. I get it's gonna be harder. It's gonna be harder for me too. Um, Money checkup. Hello from the Bay. Welcome from the Bay. Grew up in Milpitas. Went to Milpitas High School. Maybe we are neighbors. Ram call. I'm renting a single family home for 2,200. What would be a good price for me to buy it for? Which market are you in? It's hard for me to know unless I know your market, right? But if your rent's 2,200, um, geez, that you can be anywhere. I think that's the average rent. Steven, what lender is that? I'm doing a cash out refinance right now, and that'd be very helpful. So Jordan, if you click on my link tree in my description, I have a link to my lender from Lending One. So they're currently my favorite debt service coverage ratio lender for a cash out refinance. They do 75% cash out refinance, and they require 3 months of seasoning. It's going to be a 5-year prepay. But I really like them. So click on my link tree, and then from there you can try Lending One. And if they don't work out, just send me an email, which is in my link tree as well, and I can connect you with who I use in Ameritrust. So that's my second lender that I use. But between these two, that's probably gonna be the main two that I'm using. Brian says, "Come to Florida on the Emerald Coast." Don't know too much about the Emerald Coast. I've been to Florida one time in my entire life. I went to Disney World, and I went to Tampa, then I went to Miami. I fear hurricanes, if I'm being honest, but yeah, I like the oceans. It's more swimmable. It's compared to the Pacific Ocean. It's cold. So definitely we'll check it out. Maybe like if I retire, like what I want to do is I want to get like an RV. I don't even know how to drive an RV or manage an RV, but just drive an RV and just go to all the national parks. I feel like that's a very American thing to do. And it's a cheaper way to do national parks because hotels and national parks are like 300 to 500 bucks a night. So I would love to be able to get an RV, rent it, and then just like go to all the national parks and like slow travel over like a month or two and just live out of an RV. Like I don't know, like if anyone's done that, let me know. I'm curious to like see what that's like. But that's something that I really wanted to do because I want to see all the national parks. Um, so it's really something that I've been thinking about. But like I said, I can't do it when I have a W-2, right? So that's me when I'm retired. Andrew, I personally like having a small portfolio that I self-manage. Yeah, totally. Like there's this YouTuber who I watch, Dion. He's on the One Rental at a Time community, but he basically is a lazy investor, and he owns I think 18 doors amongst 8 properties. So he owns like duplexes, triplexes, fourplexes, and then basically he self-manages his properties. And I think he said he grosses like 35K, and his PITI is 9,000 bucks a month. And I was like, how is it so low? So he grosses 35K. His PITI is 9,000, and then he sets aside 5,000 for like reserves and future capex and repairs. So he cash flows about 20,000 bucks a month. And I was like, how's your PITI 9,000? I feel like PITI in one of my properties is almost 9,000. So Maybe I'll get there one day. Maybe I have to sell some properties and own some free and clear to get there. So yeah, I may be that person who sells a bunch of my out of state properties and then just own a bunch in nearby me that I self manage with a bunch of ADUs. Who knows? I might get to that point in the future. Um, Humphrey, do you have any Section 8 tenants? It's popular in Dallas, Fort Worth, Texas, due to higher rental amounts set by HUD. So yes, I do have one Section 8 tenant in San Francisco. And what's nice about Section 8 is that they require annual inspection. So it at least keeps your tenants in check to make sure that they don't trash the property. And also, what's nice about Section 8 is that it's guaranteed rent. So during COVID, my tenant lost, I think, their job. And then what happened was Section 8. So in Section 8, they cover a portion, the tenant covers a portion. So like, for example, if the rent is 4,000, the tenant may pay 500, Section 8 pays 3,500. And with Section 8 rents, you can look up the fair market rents every single year. So I could Google search fair market rent for San Francisco County 2026. And it'll show me what the new rates are for a 1 bedroom, 2 bedroom, 3 bedroom, 4 bedroom. And if you see that your rents are below the voucher amounts, you can do a request for rent increase. Your Section 8 tenant has to sign it, and then you submit it to Section 8 Housing Authority, at which point they'll approve it, deny it, counter you. And then basically they'll break down the new portion. So they'll be like, okay, Section 8 now pays this much, and now the tenant pays this much. So I do have it. As of any tenant, Section 8 tenants, they can be really good, they can be really bad. I'm fortunate I have a really good Section 8 tenant, but Section 8 has a bad stigma where you're dealing with people who are, for if I don't sugarcoat it, they're borderline homeless potentially, or they're like typically like a single mom with like a bunch of kids, right? That's a typical demographic of a Section 8 tenant. And then like it is guaranteed rental income during the good times, during the bad times. But yes, you're going to have to deal with maybe some more paperwork. Maybe you're going to deal with annual inspections. But for me, I prefer the annual inspections. For my apartments, my property managers don't really like Section 8 because they know it's more work for them. But for me and my portfolio, like I have one and I had a great experience, but it's only one experience, right? So I know a lot of investors who, like, if I were to have, let's say, like, if you want to go Section 8 route, and let's just say you have 30 doors, like I wouldn't do more than 30% of your portfolio. So 10 doors, Section 8, because you want to diversify, right? You don't want to like put all your eggs in one basket. So if you do go down the Section 8 route, make sure it's not more than 30% of your entire portfolio, right? But what I do like about Section 8 is you can look online what the rents are, and it's transparent. You see it, and you can raise your rents accordingly. And then you can show your tenant, like, hey, this is the fair market rent. I'm going to raise it by this much, right? And if you go above the fair market rent, so what I learned is, let's just say the fair market rent is $5,000 in San Francisco for a 3 bedroom. If I can show them sales comps, like so Zillow listings of properties, similar bed size, similar condition, and I show the Zillow listings within I think within 2 miles, if you give them those listings, they'll go above the fair market value. So that's why I did. Like, let's just say like the rent was 5,000 and I wanted 5,200, right? And at first they denied it, but they said, oh, but if you show me some listings that support 5,200 within like a 2 mile radius, we're happy to honor it. So I just went on Zillow, put the filter in for a 3 bedroom, did a filter within like, a 2 mile radius. And I just pulled up 3 Zillow listings to say, hey, I found 3 at 5,200, and they honored it. Right. So that's the good thing about it. But one thing I will say about Section 8, what people don't realize is when you first onboard a Section 8 tenant, sometimes it takes them a while to set up the paperwork, to set up the payment portal. So you might wait 2-3 months before you get the money. But the moment the portal is set up, they're going to lump sum you. So let's just say they owe you 3 months of rent, and it's $2,000 a month. They're going to lump sum you $6,000. And then at that point, every month on the first, I get automatic payments in my bank account on the first every single month, never a miss. Right? So just take the good, the bad. Another question here is, can you find a house with 800K house with 8 bedrooms in California and rent out all the bedrooms for 1K each? Ooh, so I did that with a 5 bedroom house. If you do go down that route, you're probably gonna have to have an ADU in the backyard, I'm guessing. Or if you're like buying a duplex where each 4 bedrooms on each side, but you're not going to buy a 100K house in the Bay Area. It's going to be maybe more in the outskirts, right? Like I remember I was looking back in 2017. There was a fourplex in Sacramento, Midtown Sacramento, for $500,000, and it was all 2 bedroom, 1 baths. And I said no to that because I was afraid of Sacramento. I wasn't nearby to me. I didn't know the area. I was listening to my aunties and uncles who told me, don't go to Sacramento, in my bet, it came from a good place. But had I got that, it would have been $500,000. And each unit now, the rents for a 2 bedroom, 1 bath, assuming it's renovated, would be probably, I'd say, close to $2,500. That's $10,000 in rental income for $500,000. And it would have probably by now appreciated to closer to $1 million, generating 10K a month. And if I put 25% down on 500,000, my loan's about 350 at 4%, and you're getting $10,000, assuming you have good tenants and they stay there. So, like, I think that is possible, but you're gonna have to not be in like the big cities like LA or the Bay Area. You might have to go a little further, like maybe Sacramento, where maybe you're getting a fourplex. So I might do that. I've totally considered, not now, but maybe like if I were to buy another property, once everything is stabilized and once I hit my financial freedom, like I might buy like a fourplex or like a triplex in Orange County somewhere. I'm thinking like Orange, Anaheim, Fullerton, Garden Grove, that area. Buy a fourplex, and then basically build ADUs there as well if you have a big enough lot, and then own those ADUs free and clear, and then use that as a cash flow play. So maybe I can 1031 exchange my 26 unit in the future if I get sick of it. Use that to buy a fourplex in Orange County, and then eventually over time fund the ADUs in the backyard, and then own that all the ADUs free and clear, and then increase my cash flow. So that's something that I've been thinking, but that move I just described might be like 5-10 years from now. Who knows? But it is possible to find an 800K home in California for 8 bedrooms. You just got to be open to where it is, right? W Dong, I buy single family homes in Connecticut, 3 bedroom, 1.5 baths, then convert them to 5 bedroom, 2 baths. Section people really love them. I guess the 1% rule under current market. So that's a nice unfair advantage there. So like you're buying a house that's 3 bedroom, 1.5 bath, and then you're adding value because Section 8, they only care about bedroom count, right? So if you can cram pack 5 bedrooms into like 2,000 square feet or 1,500 square feet, it's gonna feel tight. But Section 8 doesn't care about the size of the bedroom. They just care more about, is there egress? How many bedrooms are there? So, if you can convert a 3 1.5 to a 5.2, you can increase the value based on the sales comps, but also you get more rents. So that is a nice strategy there. That's a nice unfair advantage, but you have to know how to structure your house. So like a lot of times, like living rooms are obsolete now. Like you can convert living rooms into like I remember in the first house I lived in, I had a huge living room. I could have easily converted that living room into 2 more bedrooms. And now I went from a 4 bedroom to a 6 bedroom. And literally it's not gonna be that expensive to like add 2 more bedrooms of a closet, right? Like, and that house has like 3.5 bathrooms, so it's a lot of bathrooms. But like adding, basically 2 more rooms, it's basically just drywall. Yeah, it's just basically some wood and some drywall, and then you have 2 more bedrooms. I can convert that living room into like 2 more bedrooms, and I still have a huge family room that you can use. But like living rooms are like obsolete now. So if you get creative, I can do that right now too. Like with my property I bought in the Bay Area, it's 4 bedroom, 2 bath. I can even the master bedroom is huge. Like the master bedroom is the size of 2 master bedrooms. I can cut that in half, add another bedroom there too. So if you kind of get really creative, that's how you do it, right? Um, let's see here. Agreed. Inland Empire, Riverside, the houses are 800K. Yeah, I don't know Inland Empire too well, but I just know like the stigma is a high crime. But if you can find a nice pocket in Inland Empire where you can get like a fourplex or a duplex for 800K and you have an unfair advantage there, then by all means go, right? But I don't know the area well enough for me to really dive into that market. But like you said, if that's your unfair advantage, go for it. Like I totally would too. You really look young for your age. Thanks for that. I've been feeling really old because I take on more stress than I need to between my W-2, between my media business, between my real estate, and trying to become a real estate broker. But I am 35 years old, and I'm trying to stay young. I try to stay lighthearted, and I'm trying not to age, right? And maybe a good moisturizer. You can thank my wife for that moisturizing skincare routine. Um, if I don't see houses having conversion potential, I don't buy. So, W Dong, it seems like, yeah, you have your buy box. It seems like you have your unfair advantage, and leverage that and scale that, right? So that's what I would do. Bob, do you get private money hard? Do you get private hard money loans for your investments? No, I've never done a private money hard money loan. I've only gone through lenders, and then I self fund everything myself. So I leverage a lot in the beginning. I would buy a property, and then once they appreciate, I do a cash out refinance. Use that to buy more properties, right? I use lines of credits as well. So I've never done private money lenders. I never partnered. I never syndicated. I just self scaled myself to keep it simple. I'm glad I went that route. Did scale up to 90 units at one point, but was completely miserable and losing a lot of money. So I sold my mobile home park for a loss. Now I'm at 54 units, but now I'm looking to trim my portfolio even further, right? What do you think about other hard assets such as gold, collectibles? Um, sorry. So I do own some gold. So for our wedding, some family member gifted us gold. I guess it's a very Asian thing to do. I'm not a huge fan of gold, to be honest. I don't know. It just doesn't really do much for me. So it's a I don't know. I don't collect art. I don't collect gold. I don't do watches. I don't do fancy cars. Like I don't know. To me, it just doesn't really do much for me. Like my hard asset is real estate already, and I own enough of it already. So if you like gold, you can hold on to it. But I don't really know much about it. I know gold has skyrocketed recently. Like I remember, it was so funny. I was in Vietnam at this like flea market or this night market, and like I saw this long line, and I was like, what are these people doing? And everyone was like selling their gold jewelry because the price of gold is so high. So people are trying to cash out of their gold to basically just lock in the gains. But I don't know. I don't think gold has done that well. I'd rather just dump into SP 500, to be honest. Bob W moisturizer. Yes, maybe I'll be sponsored by a moisturizing company one day. I don't know. Right. I think we use. I remember it's some Japanese moisturizer that we bought in Japan. No idea. Maybe they'll sponsor me one day. Um, how do you evict the bad tenant in California? I mean, the process of the city. So I've never had to go through eviction process. But I just know it's painful, it's long, and it costs a lot of money, right? So I fortunately never had to do it. But yeah, I just would touch base with like a property manager, maybe a real estate attorney. Maybe they can guide you better. I hope to never have to do that, right? What's the difference between getting lenders and private money hard loans? I thought they were the same. Sorry, this is a dumb question. So lenders, so good question. So lenders, there's conventional lenders. So these are like Fannie Mae, Freddie Mac lenders backed by the government, right? So this is like Chase Bank, Wells Fargo, big banks, right? They're gonna look at your debt to income ratio. They're gonna ask for your credit score, tax statements. Then you have a lot of non-QM lenders. So this might be like Lending One. So Lending One is backed by, I think, Blackstone or BlackRock, one of those black things. And they basically, let's just say like investors put money into um, Blackstone or whatever, and they pay them 5% on their money, but they go lend it out at 7%. So that's kind of a more of a private hard money lender or non-QM lender. To me, when I consider a private money lender, that's like me asking a friend, me asking a family member, me asking like my dad to be like, hey, can you give me a loan of 30K at 10%? So that's my distinction. So like to me, a lender is like somebody that like a bank, or they are like private money, or like a bank, whether they're a QM or non-QM lender. Private money is like going to a friend or going to like a family member that you know. That's, at least in my mind, that's how I think of it. I might be wrong. Who knows? Thanks for the sub. So anyways, thanks for staying with me for so long, for an hour and 20 minutes on Thanksgiving Day. Football starting right now. I think it's Packers versus Lions. So people are probably falling off, but thanks for staying on. Thanks for engaging. Let me know what questions you want to talk about in next live streams. But if you want to join my school community on a free trial, network with other like-minded real estate investors. If you want courses, you want coaching, if you want to get a steadily landlord insurance quote, if you want connections with my lender, Lending One, if you want to send me an email, it's all my link tree. Just click on that, Otherwise, please like, comment, subscribe, and hope to see you in the next one. Thank you so much and enjoy your Thanksgiving and please spend time with your family. Thank you so much.